Good day, everyone. Adrian here from Tradeology, and today we're going to discuss Bollinger Bands. Bollinger Bands are a technical analysis tool invented by John Bollinger, born 1950, a famous technical trader. He is one of the world's leading technical analysts, who wrote several books on technical analysis and received numerous awards, amongst others, Lifetime Award for Outstanding Achievement in Technical Analysis. Bollinger Bands is a volatility indicator. The bands are indicating overbought or oversold levels relative to the moving average. As we'll see on the chart here, this is how it will display. You'll have an upper band and a middle line, which is representative of a 20-period simple MA, and a lower band. Now, the basics of Bollinger Bands. Bollinger Bands consist of an end-period simple moving average, an upper band at K times, an end-period standard deviation above the moving average, lower band at K times, and end-period standard deviation below the moving average. Now, the Bollinger Band is a simple moving average that is usually set at 20 periods. Since the standard deviation formula is using the simple moving average, that's why the simple moving average is used in Bollinger Bands. Now, the look-back period for the standard deviation is the same as for the simple moving average. The outer bands are usually set 2 standard deviations above and below the moving average, and that moving average represents the middle band. Bands adjust themselves to the market conditions very well, since standard deviation is a measure of volatility. When the markets become more volatile, the bands widen or move further away from the average, and when markets become less volatile, the bands contract or move closer to the average. When the bands contract, it's usually an early sign that there will be a sharp increase in volatility. Now, there are numerous ways traders are using Bollinger Bands. Some traders buy when price touches the lower Bollinger Band and exit when price touches the moving average in the center of the bands. Other traders buy when price breaks above the upper Bollinger Band or sell when price falls below the lower Bollinger Band. Bollinger Bands are mostly used alongside other indicators that will confirm the signals. For example, Bollinger Bands in combination with ATR or above true range will produce good results since the ATR focuses on total price movement rather than on just the price, and both indicators are using different approaches to looking at volatility. The other often used combination is Bollinger Bands in conjunction with rate of exchange or ROC, an indicator used to identify volatility breakouts. So, playing the bands is a method based on the fact that the majority of all closed prices should be between the Bollinger Bands. So, when a price moves outside of the Bollinger Bands, which is quite rare, it should not last long and revert very soon to the moving average. So, having a look at the image, in this method, a buy signal occurs when price falls below the lower Bollinger Band. As indicated on the image, you can see clearly in the 3 spots indicated that price has moved below the lower Bollinger Band. A sell signal is the opposite of a buy signal, which means it will occur when price goes outside or above the upper Bollinger Band. And once again, in the image, we'll see the price has moved outside of the Bollinger Band and is a signal for a sell trade. Now, the exit rule in this situation is that the trade is taken out by the opposite signal. Thus, if we are long due to a cross above the lower band, a cross below the upper band, this would close the existing long position and establish a short position. The reverse is also true. Let's have a look at a more conservative approach to playing the bands. Instead of buying or selling when the price closes outside the bands, the more conservative approach would be to wait for the price to move outside of the bands, but then move back and close inside. This helps to reduce losses when price breaks out of the Bollinger Bands for a while. However, many profitable opportunities would be lost. On the other hand, this could prevent painful losses. Let's have a look at Bollinger Band breakouts. This method is basically taking the opposite approach of the playing the bands method. Breakouts usually occur after a period of low volatility, after which the price closes outside of the Bollinger Bands. As mentioned before, other indicators are often used in conjunction with the Bollinger Bands to confirm the signals. In this case, support and resistance can be very helpful when deciding whether or not to buy or sell in the direction of the breakout. For this method, we can say that the signal occurs if the price breaks support or resistance and then closes outside of the bands. So let's have a look at an image here for a buy signal. In this method, the buy signal occurs when the price breaks resistance and after that it closes above the upper Bollinger Band. As we can see clearly in the image, price broke above the resistance and then closed above the upper band. We would then have a signal for a buy trade. A sell signal in this method occurs when the price breaks support level and then closes below the lower Bollinger Band. And as indicated in the image, you can see clearly price broke below the support level and then closed below the lower band. Now we need to also look at determining a strong trend using the Bollinger Bands, and direction and strength of the trend can also be determined using the Bollinger Bands as shown in the image below. On the image, you can see that a strong trend in the upper half of the Bollinger Bands occurs where indicated, and the moving average acts as support in this instance. On the other hand, during a downtrend, price tends to stay in the lower half of the Bollinger Band and the moving average acts as a resistance. As you will see in the image, we have the moving average acting as a resistance in the middle band there after a strong downtrend in the lower half of the Bollinger Bands. Now, volatility strategies and breakouts. Standard deviation is a statistical measure of volatility. If the prices are constantly changing, the standard deviation will be higher. In that case, the Bollinger Bands will self-adjust by widening and shrinking depending on volatility. When volatility is high, the bands widen. When volatility is low, the bands shrink. After the quiet period of low volatility, usually we can expect a breakthrough and a strong trend with high volatility. This is a good moment to enter the trade when the price breaks out and closes outside of the bands, as indicated in the image. Now, a buy signal occurs when the period of low volatility usually stops when a breakout occurs. This means that a price will close above the upper band. This is the movement to enter long. Sell signal will occur when the price closes below the lower band and is a signal to enter short. An exit rule: after the price pulls back to the moving average, this is the signal to exit the trade. Now, let's have a look at another method called the W bottoms and the M tops. W bottoms and the M tops are patterns which occur on the chart forming the letters W or M. With the W bottoms, Arthur Morrell was the first to identify 16 patterns with a basic W shape. Bollinger then used them in conjunction with Bollinger Bands to identify W bottoms. There are 4 steps to determine a W bottom. Reaction low forms. This low is usually below the lower band, but that is not always the case, nor is it a rule. Next, there is a bounce to the middle band, the simple moving average. After that, there is a new price low. This low holds above the lower Bollinger Band, and that ability shows less weakness. Finally, the W bottom pattern gets confirmed with a strong move off the second low and breaks the resistance. And this we can see in the image, that price touched the lower band and created a new low, then bounced to the middle band. After that, it formed a new low. Finally, the W bottom pattern gets confirmed with a strong move off the second low and breaks the resistance. The M tops, just like with W bottoms, Arthur Miller is the man behind recognizing M tops patterns, and Bollinger used them in conjunction with the Bollinger Bands. Double tops, head and shoulders patterns, and diamonds represent evolving tops. Basically, an M top is similar to a double top, although here the reaction highs are not always equal. The difference is that the first high can be a higher or lower one than the second high. This is basically the opposite of the W bottom. There are 4 steps with this method also. First, a security forges a reaction high above the upper band. Secondly, there is a pullback to the middle band. Third, price moves above the prior high, but doesn't reach the upper band. This is a warning signal. The inability of the second reaction high to reach the upper band shows waning momentum, which can foreshadow a trend reversal. Final confirmation comes when the price breaks the support level. You can see this clearly in the image. The M on the image represents this movement, and we can see price touches the upper band, moves back down to the lower band, comes up again, and falls down again to below the middle band through support. Now, there are a lot of ways traders use Bollinger Bands. Some of them buy when price breaks above the upper band and sell when price falls below the lower band. Other traders buy when the price touches the lower band and sell when it touches the upper band. Low volatility is identified when bands come close together, and high volatility period is detected when bands are far apart. When the bands have only a slight slope and lie approximately parallel for an extended time, the price will be found to oscillate up and down between the bands as though in a channel. As with almost every other indicator, Bollinger Bands is best when used with other indicators to confirm the signals. In particular, the use of an oscillator like Bollinger Bands will often be coupled with a non-oscillator indicator like chart patterns or a trend line. If these indicators confirm the recommendation of the Bollinger Bands, the trader will have greater evidence that what the bands forecast is correct. Although created in the early 1980s, this indicator is still one of the most used indicators amongst traders. Combined with other indicators, it can produce great results and can be used when trading stocks, Forex, and so on. In fact, it was also used outside of the financial area. The International Civil Aviation Organization used it to measure the accident rate, while Henry Y.T. Negan and Grantham K.H. Pang presented a method of using Bollinger Bands to detect anomalies in patterned fabrics. Thanks again for watching, and please remember to subscribe to our channel below to receive notifications, so whenever a new video is released you don't miss any. And again, for a free system, also check out our link in that description below.